What's up, guys? We're going to be breaking down the One Big Beautiful Bill Act and all the changes, big and small, that are relevant to someone who's approaching early retirement. So this is maybe somebody in their late 40s all the way to maybe early 60s thinking about transitioning to retirement. We're going to break down all the different elements of this tax bill that you actually need to know. So we're going to go ahead and dive right into it. Before I do that, my name is John Boyd. I'm a certified financial planner, and I'm the founder and lead wealth advisor at MDRN Wealth. If it's your first time here, welcome. If you're a returning viewer, welcome back. If you need one-on-one guidance after watching today's video, reach out to us at www.modernwealth.com. That's modern, spelt with no vowels, wealth.com. So let's go ahead and dive right into it. The first major change that is not so much a change, but a continuation that came as part of the One Big Beautiful Bill Act is the fact that the current tax brackets that we have in place, that were put in place as part of the Tax Cut and Jobs Act in 2017, have been made permanent. And that's a big deal because, as you can see here on your screen, the brackets that came in as part of TCJA, for example, lowered the 15% tax bracket down to 12, it lowered the 25 down to 22, and so forth. So now we're in this period where taxes were reduced as a result of that tax bill. However, this was supposed to be temporary. It was supposed to expire, and higher tax brackets were supposed to go into effect next year. But with the One Big Beautiful Bill Act passing, the lower tax brackets are now made permanent. And that's a big deal because a lot of folks were scrambling thinking, hey, I need to do Roth conversions. I need to incur more capital gains. Whatever it is, they were looking to accelerate a lot of income. But now we have a lot more time because now these brackets have been made permanent. The other big part of this tax bill is that the enhanced standard deduction that was put in place as part of the Tax Cut and Jobs Act has been made permanent and has actually increased a little bit. So starting in 2025, the standard deduction if you're filing a joint return is $31,500. And if you're single, it's $15,750. So that larger standard deduction is a big deal. And it's one of the reasons why I think a lot of people are going to be able to have a 0% capital gains rate, which I'll talk about here in a little bit. The other thing to be aware of, and again, not so much for early retirees, but maybe somebody who is maybe in retirement or thinking about what life is going to look like later on in retirement, is the fact that there is now a temporary senior bonus deduction of $6,000 per person. Now, there are phase outs associated with that, and I'll put that up on the screen here. But starting in 2025 through 2028, there's now this enhanced senior bonus deduction that you get to claim on top of the standard deduction. So if you're married filing a joint return, this is gigantic. This is really big if you're over 65 or getting close to 65, because you'll be able to take advantage of this between 2025 and 2028. Again, it's going to be a fantastic opportunity to realize more capital gains, do larger Roth conversions, all because you have this larger enhanced bonus deduction. Now, a little side note to this is a lot of people, as part of this enhanced deduction, are under the impression that Social Security is no longer taxable. This was a big campaign promise that Trump and Republicans were talking about, that Social Security taxes were going to go away. The taxation around Social Security is exactly the same. There's nothing different about it. And we'll include a link to a video that we did talking about how exactly Social Security is taxed if you're curious. But basically, the math behind how much Social Security is included in your taxable income is going to remain exactly the same. However, because of the enhanced senior bonus deduction, not a lot of people's Social Security is going to be taxed as a result of it. And again, this is only temporary from 2025 through 2028. All right, so I've kind of alluded to it a couple times, but one of my favorite parts of the Big Beautiful Bill Act is that it keeps intact the 0% long-term capital gains bracket. This is really huge because there was some speculation that maybe this would be modified in some way. But the 0% long-term capital gains bracket is here to stay. In 2025, this is what we're working with. If your taxable income is below $96,700 and you're filing a joint return, or $48,350 if you're single, then your long-term capital gains rate is 0% on the federal level. Now, I want to highlight that it says taxable income. The reason why this is a big deal is that there's a lot of people out there that will look at this on the surface and think, well, $96,700 is not a lot in taxable income. It actually is, because this is how it would work. Let's say that you had $80,000 in ordinary income, and then you incur a $30,000 long-term capital gain on top of that. Our total income right now is $110,000. So you're looking at that and thinking, well, shoot, I'm going to be subject to 15% capital gains on that $30K of capital gains that I incurred. But what you need to factor in is that big old standard deduction. So if you're filing a joint return, you can take off $31,500 from that amount. Now your taxable income is $78,500. So as you can see, we can actually have over 6 figures in income, and after we factor in those deductions, our capital gains bracket is still 0%. That's a big deal. And in this scenario, we still technically have more room to go, because we could technically have a little bit of Roth conversions here. We could incur more capital gains and still stay below that 15% long-term capital gains rate. Again, everything is 0%. So we'll tie all this together at the end with a little case study if you're feeling a little bit lost. But just a couple other tax items before we get to that I think are notable to bring up. First, charitable deductions for non-itemizers. I think this is a big deal. This starts in 2026. So charitable giving, really since 2017, since the Tax Cut and Jobs Act was originally put in place, there really wasn't a huge tax benefit to charitable giving unless you itemized on your return. And again, this is because that big old standard deduction. It's just hard to get more than $31K or so in itemized deductions if you're filing a joint return. However, as part of the One Big Beautiful Bill Act, starting in 2026, if you file a joint return, you can deduct up to $2,000 in cash gifts on your tax return without itemizing. And that's $1,000 if you're single. Now, I want to highlight that I said cash gift. So if you're someone who already donates, let's say clothes to Goodwill every single year, and you think, well, that amounts to $2,000 in clothes and other stuff that I donated, well, that doesn't count. It has to be a true cash gift. Last two pieces that I think are notable is that the SALT deduction cap has been increased, and this is going to apply all the way to 2029. Now, if you're not familiar with that, this is something that was introduced in the original Tax Cut and Jobs Act that reduced how much state and local tax that you could deduct off of your tax return. So if you're someone who lives in a state like California, like me, and let's say that you had $30,000 worth of state taxes, $15,000 in mortgage interest, and we add all that together, that's $45,000 in itemized deductions. That's a lot better than, let's say, that $31,000 in standard deduction that you would take. So you would obviously itemize here. Well, the Tax Cut and Jobs Act capped how much state and local tax that you can include on your return. So I couldn't count the $30,000 that I paid here. I could only count $10,000 in state and local taxes. So that cap really hurt a lot of people in high tax jurisdictions paying a lot of state and local tax. But now, as part of the One Big Beautiful Bill Act, that SALT cap has now been bumped from $10,000 to $40,000. So if you're someone who pays quite a bit in state and local taxes, I think this is going to be a really good thing for you. Now, I want to highlight that the enhanced SALT deduction cap from $10,000 to $40,000 phases out starting at $500,000 in adjusted gross income. So if you're someone who's higher income, The name of the game for you is going to be keeping your adjusted gross income below $500,000 so that you can take full advantage of that SALT deduction. The last thing we're going to cover before we hop into our case study is regarding ACA tax credits. Now, this is a big deal for folks heading into early retirement because a lot of folks aren't going to be eligible for Medicare and they have to have a marketplace plan to get health insurance. Well, part of the COVID era tax relief, we got something called enhanced ACA credits. And what these enhanced credits did is that they provided some tax subsidies to cover health insurance costs for folks over 400% of the federal poverty limit. Well, starting in 2026, we're going to go back to the old rules prior to COVID, meaning that if you are even $1 over that poverty limit, you're no longer going to receive any tax subsidies. This means that you're going to be on the hook for the full sticker price of the health insurance plan. Again, that's 400% of the federal poverty limit. Now, the big things that I want to highlight about this, and again, this is probably a separate video, but again, just two things, is number one, there's a lot of talk about how the new tax bill got rid of ACA tax credits entirely. That's completely false. There's definitely still tax credits to reduce how much you're paying in premiums through the open marketplace. The second thing is that there's a lot of tax pressure to reduce your overall tax liability. If you're even $1 over that 400% federal poverty limit based off your household, you're not going to get any ACA tax credits. And that's a big deal because you're going to be on the hook for that full price of that plan. So let's go ahead and dive into our case study here. And I'll go ahead and pull this up on my screen here. But again, I think visually seeing it will tie it all together. So what we're working with is somebody who retired early. And you can see they don't have any W-2 income coming in. However, we have a little bit of portfolio interest that's generated. They have a little bit of dividends. Other thing that I want to highlight, this couple that we're looking at in this case study, they're both 53 years old. And so they're taking IRA distributions. However, they're exempt from early withdrawal penalties because they're taking advantage of 72T. Again, that's a separate video that we've done in the past. But again, just the long and short of it is that if you've retired before 59 and a half and you're trying to take advantage of living off of your retirement account without that 10% penalty, this is a way to do it. They're taking advantage of that. So they don't have any penalty on that $60,000 of IRA distributions. And so we fast forward, we go and take a look at what their taxable income is, or excuse me, their federal tax liability. It's only $3,423. Their effective tax rate, let me go ahead and pull this up here just to visually tie it all together. We're looking at an effective tax rate of 9.6%. Now, if we go ahead and add in, let's say $60,000 in long-term capital gains. So I have that in to start, but let me go ahead and re-add it back in. If we add in $60,000 in long-term capital gains, let's say that they had a stock, it's worth $200,000, they sell it and they incur a $60,000 capital gain from doing so. Assuming that's a long-term cap gain, we can take a look. Even though their adjusted gross income is now $127,000, we factor in that larger standard deduction and take a look at what their taxable income is. It's $95,500. However, their effective tax rate is 3.6%, and that federal tax bill that I brought up earlier didn't budge. It's still $3,423. And again, the reason for that, guys, is that the larger standard deduction and the fact that 0% capital gains rates are still here, this couple was able to not pay any federal tax on that cap gain that they incurred because their taxable income is below that threshold of roughly $96,700. So again, that's a big deal as you tax plan and look for ways to generate income in early retirement. So there you have it, guys. If you like today's content, be sure to like and subscribe. And if you need help coming up with your own retirement plan that perhaps looks a little bit like this, reach out to us at www modernwealth.com. That's modern spelled with no vowels, wealth.com. I will see you next time.